Hi everyone, welcome to the latest of our virtual ILS NYC 2021 event broadcast. Please do visit the event website to see the details of our kind sponsors without who we couldn't put on these types of events, as well as to view all of the other video sessions from the conference, which will be archived and available to you for the foreseeable future. So with the event, obviously, we're looking at the development of the ILS market, always with one eye on what's coming down the line in the future. And this year, we're focusing on defining the next generation of the sector. And for this particular broadcast, which is loosely titled Spreading the Word of Alternative Capital Beyond CAT Risk, it's something that we often talk about in our events, but progress has been slow perhaps to date. So today we're going to explore what's actually happening in the marketplace and what can happen going forwards. So with great thanks to our sponsoring partner Vesttoo, who are involved in this session, and our other speakers, we'll also explore technology and how that can play a role in enabling the transfer of longer-tailed risks to the capital markets. So I'm delighted to be joined by Yaniv Bertele, Chief Executive Officer of Vestu, Thibaut Adam, Managing Director from Citi, Matt Beard, Managing Director at Guy Carpenter, and Kenny Durbin, Senior Vice President at Guy Carpenter. So thank you all for joining me today. We're all aware of the regular discussions about how to expand the ILS markets, remit technologies, helping to make that more achievable, expanding to risk types not dealt with in ILS previously, and also importantly, enabling new investment opportunities. So to kick off, I'm going to start with you, Yaniv. Perhaps you could talk us through your vision for facilitating this expansion of ILS into the non-CAT realm. And then perhaps you could also speak a little about how this trend may develop going forwards and what the potential role is for capital market investors there.
Sure. Thank you, Steve, and happy to be here. We believe that the industry has long been transacting with the capital markets, primarily on those exogenic, short-tail, capital-oriented risks, essentially leaving a gap, a funding gap, as we refer to it, for the long-tail risks associated with longevity, mortality, even motor claims developing, general liabilities, long-term care, all in all, lack the potential of broadly expanding way beyond the traditional reinsurance industry that has hardening premiums and lack of capabilities to capture all those risks in those combined balance sheets of the reinsurance industry. So essentially bridging the gap, creating a flexibility in terms of the solutions, the financial instruments, the collateral required, democratizing this industry to the extent that SMEs, MGAs in various industries, in various peril risks, various deal sizes, and even any type of data history could get a solution, at least in terms of immediate pricing, as to how much it would cost to transfer the risk to the capital markets. Essentially, on one hand, providing them with the regulatory compliance that they need, both in terms of NAIC and or Solvency II, while enabling the collateral flexibility on the capital market side, governed by the Basel regulatory and other aspects, creating essentially a bridge between those two industries that goes way beyond the CAT risk. I believe that once the one-stop solution is out there, enabling those two industries to communicate in a proper one single type-based conversation, understanding each other's needs and risks, we can democratize the capital markets as an alternative to traditional reinsurance and or complementing the traditional reinsurance in some manner. Eventually, maybe coming to a point where a marketplace could be created where a single transactions could automatically be generated as an interim step, working towards the vision of the marketplace, we'll need more one-stop shops, creating those solutions and democratizing them to the extent that they go way, way beyond where the cap risks are today, expanding to the new perils, the long tail risks, and the SMEs in terms of the secrets.
Thank you, Yaniv. Bridging the gap is a very good way to put that, I think, as it's something we've always talked about, connecting risk and capital. And so perhaps if we move on to you, Kenneth, if we look at the property and casualty space, there's an enormous range of exposures that potentially could be transferred to ILS investors beyond the cat risks that we largely see today. Where do you foresee specific opportunities?
Yeah, thanks for having me here. It's certainly an exciting time to be a part of the ILS reinsurance market. We're all familiar with how property cat exposures have, fit the model for ILS investors historically. The key for what exposures, the key criteria for what exposures meet the criteria for market ILS market appetite would be one, if the underlying risk is uncorrelated to the equity markets, and two, if the exposures can be modeled with an industry standard approach, which is why property cat, met the criteria for that, pretty early on in the life cycle. Exposures that meet those criteria tend to have a relatively short tail, but we're seeing that be expanded into some longer tail lines. Within the last couple of years, we've certainly seen as the ILS market has matured, we've certainly seen an increased appetite from the casualty market. Specifically exposures like personal and commercial auto, terrorism, contingency covers, business interruption, and even cyber risk could ultimately fall within the ILS scope. Essentially, as investors become more comfortable with the quantification of risks in these lines of business, we'll continue to see an expanded range of exposures that fit the appetite for the ILS market investors. So I think we're still just scratching the surface from the ILS market's perspective.
Yeah, absolutely. It seems very early days, but it's quite exciting that it's becoming something people are actively working on now rather than just talking about, which has been the case for so many years. Matt, moving on to you, you're also at Guy Carpenter, and obviously one of the areas that people have always talked about in ILS is how potentially you could explore and find a sweet spot in terms of capital requirements where instruments are able to help one company hedge its book in an alternative way or diversify its book in an alternative way, perhaps benefiting them through the capital charges being more efficient for them. It's all very logical, and we haven't seen those types of solutions being used broadly, but do you think this is somewhere that as the ILS market expands, we could find more opportunity there as well?
Yes, we certainly do. And again, thanks for being a part of this great panel today. And it is exciting to see the investor world, begin to get more comfortable and show interest in longer tail business and being creative in the ILS products that will come with that. As you said, it is very logical, but thus far the life world and the P&C world have struggled in practice to work together for this structure. Specifically in the US, life and non-life companies are licensed separately and cannot commingle the risk at the carrier level, which has created a lot of friction to be able to make those two parties work together for these types of transactions. Life companies can certainly entertain bringing ILS on the asset side. However, thus far, most of the ILS securities are not rated due to the amount of property cat risk that sits within them. And this is the struggle for the life carriers, as the unrated security results in punitive capital charges and thus hasn't made the transaction work. When securities are long and dated, like the casualty lines of business would bring to the ILS product, that will begin to allow these securities to be rated. And if we can begin to go down that path, the ILS sector will open up non-cat risks so that securities can be issued, and life companies will be a big logical buyer of those assets. And so as we start to be able to bring more of a rating and structure to the ILS world, it certainly should open up another line of capital from life insurance companies alongside pension funds and the other capital sources.
Yeah, and that's very interesting. It's something we've actually written about for probably over a decade now, is the potential for life companies to be able to allocate more to the space. So it's interesting that this expansion of perils could actually help them to do that more readily. Sticking on the broker side, Kenny, going to come back to you briefly. Would you foresee this sort of development of non-cat ILS just in reinsurance, or do you think it will be somewhere where retrosession capacity can come from the capital markets as well?
Yeah, definitely the latter. Certainly see the potential in the retrosession market. There's no reason why the retrosession market would not work, for the ILS market. In fact, we're already seeing the ILS market providing some retro solutions today. Buyers of retro products from the ILS market could either be traditional reinsurers, collateralized reinsurers, or captives. Seen a lot of appetite in the captive space recently. In particular, we've executed some transactions for a retro ag stop loss that would sit behind a reinsurer's portfolio of quota share business covering personal and commercial auto. Reinsurers find this type of retro solution appealing because it really limits their downside potential and can sort of trap in their expected loss ratio and margin. For example, so if a quota share reinsurer has a portfolio of auto business, say with the expected range of around 70%, we could structure a retro X stop loss product that protects them for, say, a 20-point range, excess of 90% or excess of 95%. So as the attachment point goes further out into the tail, the more affordable that X up product becomes, and makes the transaction easier to put together.
Great, thank you, Kenny. That's interesting as well. Yaniv, at Vesttoo, you've been sort of tailoring your technology to provide forecast type indices on specific risks, enabling people to put a benchmark and also triggers around risk transfer potential. Can you talk us through how you see those software sort of advancements being put into action to help expand the market?
Yeah, 100%. I think the overall notion of general synthetic available indices should be transferred into portfolio specific liability indices that would, one, reduce significantly the basis risk attached to those general indices and transactions. So all in all, getting to a point where each and one of those transactions, and connecting to what Kenny just said, even on retrosession transactions, allowing the traditional reinsurance industry to take care of those first dollar losses, the quota share layers, and getting to a point where portfolio specific risks associated with a specific peril or coupled with additional risks such as loss could be modeled into one specific transaction, getting to a point where you're using a risk agnostic technology that could effectively, quickly, and accurately model the inherent risk within this specific portfolio, which could now be used in a flexible and affordable and quick manner to provide a cedent with an alternative risk transfer opportunity through the capital markets. Now, generating this objective nature of the risk modeling of the specific portfolio gets us to a point where we can now present capital market players with an objective, independent, and maybe even non-expert judgment risk modeling attached to the portfolio, and present them to large financial entities such as Citibank that can distribute those to their clients or take the risk onto their books. I believe that as part of the transition towards this type of artificial intelligence driven and enabled transactions, we would need the third party independent, globally acceptable entities to approve, if you will, the risk modeling. And as such, the steps that we took forth is to bring forth the Millimans and the S&Ps that would study the risk modeling attached to our process, understand how we go about, and present their independent seal of approval for the exhaustion probabilities, attachment probabilities, etc., and get even those independent reports presented to the potential buyers. Specifically in the debt-related instruments, having entities such as S&P credit specific portfolios. So all in all, enabling to democratize the ability to buy into those instruments way beyond the I'll call them the usual suspects of the ILS industry. You know, private equity firms, and even going down the chain to high net worth individuals that can now look on instruments that are debt-based, credit-rated, or even swap-based that would be further down the line sold through the banks to their customers.
It's very interesting that technology could potentially help people to essentially carve up their portfolios better and distribute that risk to people who are much more able to bear the risk, but also have the capital efficiency to absorb that on their own balance sheets. Do you think the technology is essential to being able to structure a transaction in sort of digestible sizes for people as well, so that you can get transactions down to a reasonable size where perhaps the distribution is much easier?
I think that would call for institutions to one, develop their own ability to break down the transaction into smaller pieces. So banks and entities such as Citi, for instance, are very capable of so and have done that before, and people can speak to that. I think that from the perspective of us as the structurers, we could look on either tranching it down to very small pieces, or eventually taking those down further down the road into publicly available instruments that would eventually not be only accessible OTC, but even on public instruments. So one instance, or again, further down the line, specific ETFs attached to specific portfolios, banks that would distribute it to their customers, and being able to tranche those transactions through SPVs that would take the LPs, limited partners, excuse me, as potential buyers, and hence each and one of the LPs could contribute their own risk appetite. So even if you do not need the SPV in terms of an OTC debt instrument, a swap transaction, one of which we structured together with Carpenter, could go through an SPV that would break it down into LPs that could essentially each and one of those buy small pieces of the risk.
Yeah, it's interesting to see the model that Fannie and Freddie have taken with their mortgage securitization seems a very sophisticated way of securitizing out with multiple layers and tranches and transactions. And it seems to me that data and technology will help to do the same with insurance risk in the future. Thibaut, I'm going to turn to you now, bring you into the conversation. So you represent Citi, one of the largest banks in the world, obviously. Interested to hear what type of perils you think are most suited for banks and also your customers as well, to take on balance sheets or to distribute out, and what type of perils do you envision the bank might be partnering on with insurance players?
Well, I think the ambition of banks in the ILS market has changed. If I look back 20 years ago, ILS was the new frontier. We were developing credit derivatives, and at the same time, we were developing weather derivatives. Banks had, as an extension of the rates trading desk, a longevity trading capability. The crisis came, I think the regulatory framework and the risk governance very much dampen all that. And right now, I think the real value add of banks is very much as a facilitator to the market rather than a principal risk taker. I do think that, and just to echo some of the comments that were made earlier, banks will thrive and be able to leverage their trading expertise and also warehousing expertise when there is, on the one hand, a proven way to value and model the risk, and two-way flows. It is very difficult to operate when you don't have standardized enough risk metrics in place. The other thing is that I think banks are really good at financing. And to a degree, through adjusting the remoteness of the risk through providing collateral on people that want to take risk but are not able to provide the collateral. I think we can play an essential role to facilitate the emergence of new tradable perils. In today's world, we have CAT specialist funds that are all, to a degree or another, also expanding onto the life risk. This is just a very small portion of the available capital. Opening up the rest, I think, requires patience and requires this both modeling, pricing confidence, and two-way flow that would enable and trigger that ecosystem. Today, to transact life risk, you need to be able to put up significant amount of collateral. If we have more standardized product where the collateral is made efficient for both the cedent and the risk taker, then I think we stand a much better chance to grow out of the usual nat-cat, cat bond type of universe.
Yeah, thank you. I'm pleased you mentioned standardization, because it's something that really is required to help expand the market significantly, I feel. When you talk about two-way flows, Thibaut, are you referring to the instruments being tradable with secondary liquidity?
Yes, I think so the banks do have a strong distribution network. That's how they operate. Mm-hmm. Beyond that, I think both the investors and the banks want to have the possibility to flip exposure around. And I get the impression that we don't see enough two-way flows. In the cat bond market, there is always a lot of attraction when a new issue comes to market, but it's extremely difficult to source in the secondary. And most of the risk are buy and hold. Again, some investors require liquidity, and finding an architecture where there is confidence in pricing and the bid ask is not too detrimental, I think would be key factors to develop that ecosystem.
Yeah, and the secondary market often seems to be governed by capital inflows to the sector rather than actual appetite to trade sometimes. So yeah, further liquidity would certainly be welcomed. Yaniv, just flipping back to you again, perhaps we could talk about life risks, and in particular, I know you're keen to work on and have been exploring value in force monetization transactions. How could this market be transformed with the use of technology, do you feel, and obviously the capital markets being the recipient of that risk?
Yeah, that's extremely exciting nowadays when the interest rates environment is as is. You have significant volatility in mortality post-COVID-19. I don't know if you can speak about the post-COVID-19, but at least in the projecting the mortality and the lapse, which might be also attached to other types of risks, like reputational risks. But all in all, looking at the value in force type of transactions where you take the provident funds, future management fees, or the pension schemes, future management fees, discount those and float the value to the holding company, I think the strong capability of a accurate methodology to model the risk, both associated with the mortality and the lapse rates, extremely in this volatile period where excess mortality and longevity are mixed and hard to predict, specifically associated with the long tail type of transaction in the value in force space. The technology is essential, both in terms of stochastically projecting it but being able also to create a flow of information between the cedent, the provident fund, the pension scheme, the bank or the buyer, and the intermediaries. So making sure the right information piece stamped with the timestamp and hashed or whatever, getting to a point where everybody could agree on the accuracy of the data. You mentioned the MBSs earlier, so accuracy of data, projection capabilities, accurately modeling excess mortality and lapse is extremely important for a successful value in force transaction, obviously taking into account also the market risks attached.
And those sort of information flows are going to be critical to getting people on both sides, the cedent and the investor, I assume. 100%.
I think people can speak to that far better than I can. But all in all, we believe that the transaction is enabled, starting with creating an objective common language between the insurer and the capital markets at the lowest common denominator basis, not using high words in insurance terms nor financial terms, getting to a point where all sides can agree on a common language, an objective, independent risk modeling that accurately takes into account all periods of risks, credit, market, longevity, mortality, lapse risks, and creating a financial instrument that would make sense from debt, credit ratings perspective for the provident fund, and also risk remote opportunity for the bank, for the risk carrier that would be able to provide the cash needs to the cedent.
Great. Moving over to you, Matt. I mean, thinking about this sort of common language, if we can develop that across a range of different perils, do you think these non-CAT ILS are going to be appealing to pension funds as they're the core investor of the existing ILS market, or perhaps a broader range of investors? And could there be any sort of capital efficiency benefits here as well?
Yes, absolutely. We think there's growing interest in diversifying risk into this space if structured properly and pays fairly. You know, the property ILS market has become a mature stage now, which we think is a positive for this non-CAT ILS space. You know, there's a lot more funds, pension funds and hedge funds out there that are comfortable with insurance risk because of the property space being mature, and now that is naturally spilling over into the non-CAT ILS space. So, you know, we've been tracking this pretty closely for the last 4 or 5 years. You know, specifically, how can we get this type of capital into longer tail business with program carriers? And that's the area that we spend a lot of time specializing in, and where we think a lot of this capacity can be well deployed. And we've seen a significant increase both from the capital side over the last few years and from the cedent side over the last few years. But the key is finding a common language, a common ground where, you know, the two sides understand the pain points for each transaction and party, but can come to an agreement about what the expectation for these products are. And we think the market is maturing to where that's becoming a reality and becoming more repeatable, and both sides understand each party at the table to help grow that. We think that the market will continue to squeeze the efficiencies as you've seen in the property space over the years. You know, as Thibaut said, banks are great at posting collateral. That's a big cost associated with longer tail lines of business. And so, you know, the fact that the institutions can do that more efficiently will be a big part of helping to recognize some of those efficiencies in this transaction. So absolutely, this capital seems to be growing in the interest for this type of transaction, and certainly seems to be suited to take advantage of the efficiencies that will be created.
And you mentioned repeatability there, which is relevant to my next question, which is for Yaniv again. I know you've been developing at Vesttoo an excess mortality industry loss warranty type product. Could you explain a little bit about how that works? What cedents and investors should know about it? Because that does seem a timely product that the industry could do with being readily repeatable at this point in our experience of the pandemic, obviously.
100%. So the idea is essentially to mimic the efficiency of the industry loss warrants that were used in the insurance space for quite some time, and present specifically the US for with a excess mortality ILW, which would develop a specific index attached to it based on the actual mortality development in the US, where a cedent, an arbitrary cedent, could buy into the transaction and get coverage for the losses associated with the excess mortality. Now, think about it this way: the excess mortality doesn't necessarily need to be a solution for a life-oriented cedent. Think about the culture industry, the restaurants, the cinemas that would suffer from excess of mortality, a pandemic that would bring them to a business stop. So think about it this way: the lockdown would be triggered based on excess mortality, and what you want to have is some sort of a parametric or index to follow that an arbitrary cedent would be able to buy protection out of, taking into account, of course, the basis risk attached to it, but without providing any data, choosing their attachment and exhaustion points, getting an immediate rate on line and buying into this instrument for whatever time necessary. I believe that the necessity of a technology in place that would be able to take into account the volatility times of excess mortality, cleaning off the signal to noise ratio and providing an accurate stochastic modeling associated with the excess mortality development is a necessary tool for us as a one-stop shop structure, which we have recently also published. We just about a couple of weeks ago, we issued our first mortality projection index for the US, which upon which we're going to structure this excess mortality ILW, and now distributing it across the US to see this. For the capital markets investors, as long as we can put forth those numbers, we believe that at least in the short-term to mid-term future, non-correlated nature of this index can possess an interesting buying opportunity for a risk-remote type of layers attached to something that everybody could relate to, the mortality within the industry. Now, regardless the buying and the risk carrier, the cedent now can buy this protection and to remove specific risks off their balance sheet attached to business stock, as I mentioned.
And I guess importantly, do you feel the protection afforded by those instruments can be made comparable in terms of price with traditional reinsurance solutions for excess mortality?
But I think the reinsurers and the traditional reinsurers themselves are starting to avoid some of the excess mortality instruments, specifically in those times, affecting their balance sheet directly. We've actually been approached by one specific traditional reinsurance to structure this ILW for a retrosession deal of theirs. We believe that these types of instruments could be later on be developed further to hedge the basis risk attached to them based on specific portfolio data. But all in all, the idea is to provide an independent excess mortality ILW, mimicking what the industry has been doing in the CAT domain with it, in order to generate a stop loss for those cedents that are exposed to business stops and excess mortality attached to what's happening today in the world.
Fascinating. Sounds like an area that the market could do with from a protection point of view, but I know a lot of ILS investors who would also be keen to see more mortality risk available in the ILS market. So I'm sure that will be interesting to them. Thibaut, moving back to you from your position in sort of the financial market side at a bank, do you feel the appetite and importantly the capital is really there to support these deals as the market expands? I know you said you think it'll be a sort of a slow expansion, steady expansion perhaps, but do you think the depth of capital will be there? And importantly, what does the market need to really think about to encourage investor confidence in this type of product?
Well, it's pretty clear there are masses of capital available. So there's no shortage of capital willing to be deployed. There is for the mainstream ILS classes, I think there is a lot of focus on pricing. We've been working on a few nonCAT sidecars over the past 2 years, and we saw a very sharp rise in interest on the back of COVID when the hardening price cycle was really on the table. And the feedback from numerous investors was that they actually hadn't even considered entering the nonCAT market since 2014. But now they felt the economics were good. So there's capital to deploy. Diversification is one thing. You need to hit the right targets they want to get at the proper time in the cycle. We also, actually last week, I was discussing with a large investor who's maxed out on nonCAT, but is very, very keen to develop further in ILS and is looking at every potential opportunity there. I think going back to the earlier point, having a standardized product and a standardized modeling view is very important. So perhaps we need to look at the next simpler structure. I think mortality is in itself quite attractive. It's a risk that everybody understands, and I think you got good diversification, a benefit. I think with modeling firms and people like Vestu working in conjunction with rating agencies, we could have a more standardized view of that risk, which should be beneficial to all. But I think the market, and when I mean the market, I'm talking about the primaries, I'm talking about the reinsurance brokers, I'm talking about the reinsurance providers. They have to embrace this as well. If they decide to shut off the tap because that's a risk they like and they actually can't get enough of it, it becomes quite difficult to place it to the capital market just because we have nothing to place. I think to a degree, the fact that US hurricane is and remains a peak peril and no one can say they have enough capacity to absorb all the market if required, that created the core incentive for insurers and reinsurers to develop cat bond programs. Maybe with what's happening on pandemics or other emerging risks that were not totally on everybody's radar, but no one within the industry feels that it's enough capitalized to actually take on by itself, then again, we create the same sort of virtuous circle, which means that the industry very much requires the capital markets. And once you get that alignment of stars, then the modeling comes in, the rating agencies are happy to step in because there will be a deal flow and it becomes an investable asset class. So I think the support of the industry, probably more than anything else, is a key enabler.
That's a really, really good point, and something that's been important right the way through the 25 years the ILS markets existed. From my side, the industry does need to support these efforts because they can unlock efficient capacity on one side and have new capital partners, which will be there for the longer term as well, which can only be good for their businesses, I feel. Matt, moving back to you, obviously that was just a brief discussion on the investor side, but if we think about the carriers, they're clearly as important as the capital in this equation. What does the industry need to do to make sure carriers and cedents are comfortable with these products and structures as they're developed?
Yeah, we think this is maybe one of the biggest short-term risks to these products is the cedents when deciding how to structure their reinsurance panels and the view of traditional reinsurance versus the non-traditional ILS capital coming in, and what that looks like for longer tail risks. You know, most of these carriers, when they think of longer tail risks, really begin to bring in the counterparty credit risk factor into the conversation. And they're still hardwired to think that the traditional reinsurers are the more comfortable, secure way to handle those longer tail risks. And so, you know, we need to make sure when we're considering the cedents that these products, one, are simple and effective to be able to communicate through the board level, the decision-making level at the cedents, because if not, it's always going to be a little bit of a disadvantage compared to the traditional product. And if they can't effectively communicate and stress these products within their final decision-making, they're going to likely err on the side of going with the traditional route. So we need to keep that in mind of what their view is as far as simple, effective, and communicating that through their organizations. We think that, you know, there's going to be some stress point that will need to take place to kind of prove that this capital understands the longer tail risk and reacts when something negative happens. You know, I think you saw that probably early on when the first storm came, when the property ILS market was growing, and everybody was curious to see how did the capital react, how did the liabilities respond, what did the capital do going forward, and we still haven't quite seen that stage fully developed for the non-CAT ILS longevity types of products. And so I think that'll be important to track, and the more the capital responds, the better it will be positioned at the board level to be a part of the cedent's reinsurance makeup. We also, I think, need to make sure the cedent is comfortable with this capital being consistent. You know, reinsurance capital is very dedicated, very consistent. It does act accordingly to the market in a lot of ways. And we think there's some concern from the cedent side that as you look at this pension fund and hedge fund capital, that it can zag and zig much quicker to another opportunity. And that leaves cedents wondering, will this capital be there when we're ready to make a decision? Or will we go through a lot of work and get to the finish line and find out that interest rates have moved, or another industry has become more popular within those funds, and they shift that capital very quickly? And that's an unsettling place for the cedents to be in. You know, finally, again, they just need to be transparent. We've got to make sure that the cedents understand if there is a secondary market somewhere, that the risk is fairly transparent for them to understand. And again, that all goes back to communicating at the board level, at the decision-making level for cedents when considering what their reinsurance makeup looks like. And we just don't want to be at an uncompetitive position when they are looking at traditional versus non-traditional reinsurance for long-tail risks.
Sure. No, it's got to be something they can actually actively compare as well and understand the different benefits from. Kenny, one question quickly for you on the MGA side, which I know is an area that the Guy Carpenter team are interested in there. Do you see ILS as not just hedging capacity, but supportive capacity for MGAs to perhaps expand their businesses?
Yeah, certainly. I think that MGAs are certainly open to the ILS market for capacity, as you know, MGAs live and breathe by the amount of capacity they can get from either insurance carriers or directly from the reinsurance market. And I would say that overall MGAs tend to be a little bit more agnostic as to the type of capital that's supporting them. And that tends to be more on the insurance company level, as they're the ultimate risk takers. But definitely seen a lot of interest in the MGA space for ILS market capacity.
So that could be a good area for people to try out new products and bring new opportunities, non-CAT opportunities to market. Okay, so closing down the discussion, just going to go back to you, Yaniv, and if you could give us a few thoughts on what other niches within insurance you think the use of advanced technology can help to unlock new ILS opportunities over the next decade.
You know what, from a high level perspective, and I'll go down to reality from the highest. I think the regulation changes affecting sustainable requirements, you know, going to the intangible risks of even intellectual property, political volatility, economic volatility. Those are all risks, even reputation risks, which are very, very hard to model today, but using the advanced and developing mathematical tools that are out there should be kept in the eyes of companies that are looking to become more relevant in creating the future risk transfers between the insurance and the capital markets. I think that looking on us as a company that takes the transaction from start to end. We would very much like to react to the capital markets appetite, as well as to the insurance industry needs, and connecting to what Kenny just mentioned on the sides of the MGAs and the SMEs. We're now looking to structure also an ILW that would cover excess claims of motor liability. So even companies with small portfolios and the lack of historical data could get protection on their business from the capital markets. And I think connecting back to what Thibaut just said, and Matt, associated with the importance of the traditional industry in maintaining this communication between the capital markets and the insurance space, is one taking the form, as we see here in this roundtable, having those two executives from the largest broker of reinsurance taking steps into the alternative capital, as well as evolving into more and more retrosession types of deals between the traditional reinsurance and the capital markets. So all in all, I believe the vision would be to use the capital markets to cover more intangible risks while reacting to the immediate needs of the cedents and the insurance space by one, structuring instruments that would make it easier for those MGAs and SMEs to tap into capacity that they have a hard time receiving at affordable means of price from the traditional industry, while always looking ahead and tying in the capital markets and convincing them, creating the common language that would eventually help them to buy into those instruments that we're structuring.
Great, thank you, Yaniv. That's all we've got time for today. So I'd just like to thank our participants. Thank you, Yaniv. Thank you, Thibaut, Matt, and Kenny. Really appreciate your time today and your thoughts. It's been a very interesting discussion, and it does sound like there's a lot of opportunity coming up. A bit of hard work first to get these things off the ground, but very exciting times for everybody. So thank you all, and I look forward to talking to you soon.